How can private equity justify a 2% management fee on committed capital and a 20% profit share across successful deals? That's normally referred to as carried interest. Now, a 2% management fee and a 20% carried interest as stock standard commercial frameworks across the whole world of private equity. Doesn't matter which country you're in, doesn't matter whether you're a minority investor or a majority investor, doesn't even really matter if it's venture capital or private equity. That 2% and 20% has survived across the decades. The real reason, of course, it's survived is because the net returns to the investors after the 2% fee and after the 20% profit share exceed returns that they can get anywhere else, such as listed public markets or property trusts or long-term infrastructure bonds. Again, if those terms are unfamiliar to you, in my Essentials of Private Equity program, I'll be describing those in great detail. Let's address the 2% management fee. If the fund is $100 million, that's $2 million a year, and $2 million a year doesn't go very far when you're paying the rent and hiring staff and doing all the things that you need to do to find the investments to then sell in the future and return the profits to the investors. Alternately, if you're a $500 million fund, 2% of that is $10 million a year, which is a pretty considerable budget. There you can pay people good money. You can even pay the managing directors and founders very good money. You can have a very good office and a very good set of systems. So the sweet spot for the 2% management fee is around about that $500 million funds under management. Where the investors get really antsy, and in my view, rightly so, is where a fund raises, let's say, $2 billion. And there's plenty of funds out there that have raised $2 billion. 2% of $2 billion is $40 million. And remember, that's an annual fee. Now, the fee at $40 million allows the principals of that firm to be very, very well paid indeed. I do want to make the point that that fee is counted as capital spent. So it's not free money. All of that money has to be returned to the investors with that minimum 8% hurdle before the general partner or the founders and managing directors of the private equity firm get their performance bonus. But once you raise that kind of $1 billion, the investors, quite rightly, are pretty antsy about the 2% management fee, and they sort of forget that it's actually seen as capital to be returned to them, with an 8% hurdle on top of that. Let's discuss the 20% performance bonus, which is the goal of all private equity firms. We call it carried interest. What it means is, if we have delivered back to the investors the minimum 8% internal rate of return on every single dollar invested, including the management fee, over the period of the fund, then the private equity fund manager is able to get 20% of the profits from that point onwards. So the investors have already returned all of their capital, or had returned all of their capital. They've already got an 8% per annum internal rate of return, and they're perfectly happy, actually, to give a 20% share of the rest of the profits back to the private equity fund. That's where the private equity executives make their real gains, their real capital. That's what drives a private equity executive to stay in the firm year after year after year, working all the hours that they can, because it's a very intense set of activities. It's the carried interest.